Good afternoon, everyone, and welcome to Pension Awareness Month. My name is Catherine Murray. I'm the Training and Engagement Manager from the Scheme Administrator for Civil Service Pensions. I'm joined today by two of my training team colleagues, Joe McLaughlin and Michelle Storer, as we guide you on your journey through your civil service pension. Our session today is called Preparing for Retirement. So if you're approaching retirement, either 10, 15 years in the future, or maybe if it's a little closer, then today's session really is aimed at you. We're going to be focusing on topics like partial retirement. What is it and how do you apply for it? We'll also be talking about the 2015 remedy on McCloud judgment and exploring what impact that might have on your decisions when it comes to retirement as well. Now, we are recording today's session, so if you miss some of the information or want to watch it back and maybe at a slower pace, then you will be able to do that. It will be available on the scheme website from around lunchtime tomorrow. And we'll be doing a question and answer session today as well. So if you do have any questions, then please do drop them into the Q&A function, and we'll do our best to answer the most upvoted questions in the later part of today's session. So to get us underway and get things rolling, I'm now going to pass you over to Joe, who's going to get us started, and we'll get things underway from there. Over to you, Joe.
Thank you, Catherine. Through this session, we'll have a look at a few different things. We'll think about partial retirement initially. We'll talk about the application process for that, things to think about before that and during the process itself. We'll think about the options for dual members as well now, because that will affect quite a lot of you will have membership of more than one scheme. So we'll touch on what that actually means in practice. And then in the second half, we'll move on to the 2015 remedy on McCloud, what that means, and we'll look at some example retirement calculations as well at that point. So partial retirement, probably many of you are familiar with the idea of this already. Some of you may not be familiar with the specifics, or it might be the first time you've heard of it. Partial retirement essentially is a flexible option that allows you to take some or all of your pension and lump sum. It's very much there for people that are thinking about retiring in the near future, but want to start to wind down a little bit. It allows you to use some of your pension to help support a more flexible build up to full retirement. Partial retirement, therefore, allows you to keep working whilst you're claiming some of that pension, and also, because you're still working, continue to build up more pension for that final retirement. Now, there's lots of things to consider before you apply. This is obviously a big change. There's lots of things to consider both on a personal and financial basis, and you'll need to work through some of that to understand exactly what it is you're applying for and how best you can use that. Now, you can use your annual benefit statement and the retirement modeler to give you an idea of both where your pension is currently and also where it's heading in the near future. So you can get a feel for where your pension might be going further down the line, or by the point that you're thinking about taking partial retirement. The figures at this point won't be exact, of course, but you'll be able to use them to get a pretty close idea about the figures you'll be looking at by the time you come to apply. Now, one of the key things is you do need to speak to your employer about reshaping your job, and that really needs to happen before anything else. For example, if you're thinking about going part-time and you want to use your pension to top up the difference, your employer's got to let you go part-time. That's got to be an available part of your job. Your employer's got to support that before you can even apply for partial retirement. Also, bear in mind the scheme needs 4 months notice. Your employer may need a different period of notice in terms of that job change, but for the pension side, we need 4 months notice to make sure that's going to get paid on time. Now, there's also some basic criteria to meet from our point of view as well. Firstly, you've got to be above the minimum pension age. For many people, that will be 55. If you joined before the 6th of April 2006, that may be 50. If you joined on the 6th of April 2006, it will be 55, and it's always fixed at 55 for Alpha. You've also got to have at least 2 years of qualifying service. For most people, you'll need 2 years of qualifying service to qualify for a pension, and of course, you need to qualify for a pension to be able to claim it. Agreeing with your employer to reshape your job by reducing your pay by at least 20% is also one of the key considerations. For many people, as we've touched on, that may be by going part-time. There may also be other ways or other considerations with your job that might allow you to take that drop as well. Now, when you've got to the stage of actually applying, the key form is called a CSP 15. Everybody loves a good form number. And this requires elements to be filled out by both you and your employer. You'll find section A is for you, section B is for your employer. They need to be filled out carefully and dated appropriately. We'll have a look at some of the sections of that form as we move through. Now, one of the key things that often goes slightly astray when people are filling this form in is the end dates and the start dates. Those dates must be consecutive. One of the key things, obviously, is the start date of your partial retirement. The end date must be consecutive with that. Those 2 days must touch. It doesn't particularly matter what day of the week the planned date is. The 2 dates there must be consecutive. There's some key considerations within there as well. It will warn you about abatement. Abatement is a limit essentially on how much in total you can claim. You can't claim too much by way of pension and new salary than you were earning before. There's lots more in-depth information about that available on the website, and there's a link, in fact, through the form. It's also a declaration to prove that you've signed off on all the relevant factors, including having used the guide that's relevant for you as well. Section B to be completed by your employer. This will be through the relevant part of your organisation. It will vary depending on your employer as to who exactly is filling that in. Can't give specific guidance on that per employee, but do speak to your line manager or as appropriate to find out who you will be completing that with. Now, the next question is, what is abatement? So the combination of earnings and pension for partial retirement must not be more than your previous earnings, known as your salary of reference. If it is, your pension may be reduced through abatement. So essentially, we will look at the pension you are claiming. We will look at your new salary, and in total, that can't be more than you were earning before. The excess is abated. Some other key facts about abatement. We always use the pre-commutation figures. Now, many of you will be aware that if you take a lump sum from your pension, that reduces the amount of pension. We always base abatement figures on the pre-commutation figures, or essentially, you can't get round abatement by trying to take a big lump sum. It will always be based on the gross values. Abatement is not affected by overtime or inflation. Normal increases to your pay and regular overtime will not affect that. We won't apply abatement just because you've taken some overtime 1 month, for example. You can choose to take just some of your pension to avoid abatement. If abatement may be an issue, you can take just some of your pension to bring you just within that limit. Also, abatement does not apply to alpha. You can claim as much alpha as you want, and that will not apply to that abatement rule. Only the older schemes. Also, it's worth noting you don't receive a back payment of abatement. That money is suspended. Once you leave, though, that will be reinstated in full and paid onwards from that point. As an example, we have a classic member that has built up a pension of 12,500 and a lump sum of 37,500. Their salary of reference is £20,000 and their re-employed salary is 10,500. That means their pension of 12,500 plus their re-employed salary of 10,500 equals 23,000. As their pension and re-employed salary equal 23,000, their pension will be abated by 3,000. It's £3,000 over the new salary of reference, or over the salary of reference. Therefore, that £3,000 will be abated. If they were also claiming any alpha pension at the same time, that can be paid in full because we don't include that in the calculation. Now, for dual members, there's a few things to consider as well. You may be a member of one scheme, you may be a member of two schemes. For those of you that are a member of two, you can claim from either or both. That will also affect your lump sum options as well. For example, we have Barbara, who is a dual member. She's currently contributing to Alpha, was previously a member of the Classic scheme. Her state pension age is 67, which affects her Alpha pension. She wants to retire at age 60. So what options will she actually have on retirement? So Barbara's got a Classic pension of £10,000 per year. That gives her a standard lump sum of £30,000. She can also take some extra lump sum And if she chooses to, that could be up to £23,517.43. That will be paid out on top of the £30,000 that is the standard. If she takes that additional lump sum, the pension would reduce to £8,040.21. Now, she's also got an alpha pension of £6,000 per year. The reduction applied for taking the alpha pension at 60 would reduce that pension to 4122 because she's taking it 7 years early, so reducing from 6,000 to just over 4,000. Her maximum lump sum available would then be £17,665.71. If the maximum lump sum is taken, her pension would then reduce to 2649.86. So Barbara decides to take all of her pension benefits at age 60 from Classic and Alpha. She opts to take the maximum lump sum from each scheme. She'll then have an annual pension of 10,690.07 and a tax-free lump sum of £71,183.14, which I'm sure she's already got some good ideas on what she's going to spend that on. So in this way, Barbara has taken benefits from both. We've not had to worry about a payment for the Alpha side. She's combined those for a quite nice retirement income. 2015 remedy will be with Michelle shortly, so I will pass back to Catherine at this point.
Thank you, Joe. That was great. Really nice to have that walk through of the CSP 15 application form. We do get lots of questions about that. There are lots of really good guides to the retirement process available on the Civil Service Pension Scheme website as well. So if you haven't checked that out yet, then the dedicated Pension Awareness Month pages do give you some information on what you can find there. We've also got our Pension Power seminars, which we run every single day, which is a 1-hour session which covers the basics of the Civil Service Pension Scheme. We also have more detailed, longer pre-retirement courses available as well. There is a cost attached to those though, but your employer will generally cover that for you. So if you're anywhere within 10 years of retirement, you might like to consider attending one of those more in-depth sessions as well. And we run those in smaller groups, so we can answer any of the questions that you have during those sessions. So really the hot topic in the world of civil service pensions at the moment is the 2015 remedy or the McCloud judgment. So I'm going to pass you over to Michelle, who's going to give you some further information to help you understand what that means, whether you're impacted by it, and what you really need to think about when it comes to making your decisions at retirement. So over to you, Michelle.
Thank you very much, Catherine. So as Catherine said, it is a hot topic at the moment. So everyone's wanting to know how the McCloud judgment is going to affect their benefits. So we're going to give you some information and look at some example calculations. So the remedy is to do with the new scheme Alpha that was launched in 2015. And it wasn't only for new starters, it potentially affected people that were already in the civil service. So those closest to retirement were allowed to remain in their original scheme. So Classic, Premium, Classic Plus and Nuvos. So some others in the public sector challenged the fact that people were allowed to move. Some people were remaining because it wasn't down to choice. It was their age that dictated if they were moving. So it was found in the courts that this was discriminatory on the grounds of age. So the 2015 remedy removes that discrimination that was identified. So the first stage of the civil service rectifying that was to put everyone into Alpha from April 2022. So we no longer have people remaining in their original schemes or their legacy schemes. Everyone's in Alpha from that point, unless they've opted to join partnership. Stage 2 is currently ongoing, so that's what we're going to have a look at. So who's impacted by the 2015 remedy? So it's those that were in the scheme on the 31st of March 2012 and were still in the scheme on the 1st of April 2015. So the remedy period, what the scheme's looking to remedy, is from the 1st of April 15, which is when Alpha was introduced, up until the 31st of March 22, so the day before everybody was in Alpha membership. So the question that we get asked a lot is what happens to my service for the remedy period? How is my calculation for my pension benefits affected? So essentially members will be rolled back into their legacy scheme for the remedy period. What that means is when a member comes to retire that is affected by the remedy period, for that 7-year period that is the remedy window, The member then will get to choose whether they would like their pension benefits paid on the alpha basis or their legacy scheme basis. So then you'll be able to see side by side how your benefits were affected from each of the schemes. You will be asked to make that decision when you come to claim your benefit. So this will become legislation from the 1st of October of this year. So you won't be asked to make a choice until you come to retire. So looking at an example of someone that's affected by the remedy, the 2015 remedy. So Mark joined Classic in April 1997. He then moved into Alpha on the 1st of April 2015, and he plans to retire when he's 58 in April 2025. So Mark can choose at partial retirement to have his Classic benefits from when he joined in April 97 up until March 22. And then Alpha from April 22 until his retirement date of April 25. Or he can choose to have his Classic benefits from when he joined in 1997 up until the 31st of March 2015. And then it would be Alpha from April 2015 to April 2025. So he will have the options to be able to determine what's best for him. So if we look at some calculations, if he was to take all of his benefits at partial retirement. So there's a lot of figures on the screen there and we'll talk through them in turn. So his first choice is to have a total pension of £9,882.35. That will be made up of Classic membership under choice 1. So that would be from the 1st of April 97 up until the 31st of March 22. So essentially choosing to be in Classic for that remedy window. So his pension from Classic for that whole period of time would be £8,531.25. And then of course he is in Alpha from the 1st of April 22. So he would have built up an Alpha pension of £1,351.10. Classic has an automatic lump sum, so linked to his Classic pension, he would be able to have that of just short of £27,000. So if he decided to be in Classic for that full period of time up until the 31st of March 22, then he can have his automatic Classic lump sum. Now, Alpha doesn't offer an automatic one, and that's one of the reasons why the accrual builds up that little bit quicker. But remember that he would be able to exchange some of his pension in order to have a tax-free lump sum for his Alpha. So that's choice 1 if he wanted to take all of his benefits on partial retirement. So then looking at choice 2, again taking all of his benefits, but then looking at the remedy period differently. So we could have a total pension of £11,117.92. But that's calculated on Classic up until the 31st of March 2015. So that represents just over £6,000 of that annual figure. And then Alpha for the remedy period, start of the remedy period right up until his retirement date. So that would be £4,970.42. His automatic lump sum, because it's automatic, would just be made up of Classic and in relation to his Classic pension that he would be taking. And again, no automatic lump sum payable from Alpha, but he will be given the choice of exchanging some of his pension for a tax-free lump sum in respect of his Alpha pension. So just some things to consider, that Mark can give up some pension from both Classic and Alpha sections to have an additional lump sum at retirement. So Classic has an automatic lump sum, but members are given the option of taking a higher tax-free lump sum, but they would need to exchange some of their pension in Classic, and it would be the same for Alpha. The online lump sum calculator, so through the portal, that will show the maximum amounts available, and it will show the impact that this will have on his pension. So if he did want to take the full lump sum from both Classic and Alpha, he would need to give up some of his pension, and the modeler would calculate that for him. So just need to move that sliding scale. But Mark can also choose not to claim his alpha benefits at partial retirement and only claim his classic pension. So that's one of the examples that Joe was talking about earlier. And that would mean that he would carry on building up more alpha pensions that would be added on top of what he decided to not take at partial retirement. And he would be given the option then of taking that when he fully retired. So then looking at taking classic benefits only at partial retirement. So choice 1, we've got classic membership here from when he joined in April 97 up until the 31st of March 2015. So this would be choosing to not have the remedy covered by the classic scheme. So his pension that he would be choosing to take then would be £6,142.50, and the lump sum for classic would be 3 times that pension. So a tax-free lump sum of £19,338.75. If he did choose to have the classic pension covered for the 2015 remedy period, that would mean that his total pension would be £8,531.25, and the tax-free lump sum would be 3 times that pension from classic, so £26,859.38. So in this option here, the first set of figures that he would be saying I want from the 1st of April 2015 to be from alpha, and in the second figures that we've looked at here, he's saying he wants his classic right up until the 31st of March 22 and then build up in alpha from the 1st of April 22. So now looking at a NUVOS example. So Michael joined NUVOS on the 1st of April 2008. He moved over into alpha on the 1st of April 22. He plans to partially retire on the 1st of April 24, and that's when he'll be age 68, so his state pension age. So Michael can choose at partial retirement to have his NUVOS benefits from when he joined in April 2008 up until March 2022, and then alpha from the 1st of April 22 until his retirement date in April 24. Or he can choose to have his NUVOS from when he joined up until the 31st of March 2015, and then choose for the remedy window to be in alpha from 2015 up until his retirement date. Now, NUVOS and alpha are both care schemes, career average schemes. So he would be used to seeing how the benefits were calculated on that. But let's have a look at the impact on his figures. So this is if he was choosing to take all of his benefits at partial retirement. So choice 1 would be a full pension of £11,506.26. So that's if he chose to be in NUVOS from when he joined right up until the end of the remedy period, so the 31st of March 22. So his pension from NUVOS would be £10,287.68. There's no automatic lump sum for either NUVOS or alpha, but again, I know I've said this a few times, but just to remind you that they would be given the option of exchanging some pension from both schemes in order to have a lump sum. And then it would be alpha from the 1st of April 22 up until retirement date, so he would have built up an alpha pension of £1,218.58. So his next option then, which would be looking at being in NUVOS up until the start of the remedy period. So essentially he's choosing to be in alpha from the start of the remedy period, 1st of April 15 up until his retirement date. So looking at the figures there, the total pension would be £11,547.92, but that would be made up of NUVOS of £5,503.71 per annum, and alpha of £6,044.01 per annum. Again, no automatic lump sum, but can exchange pension in order to have that. He has the option of taking just NUVOS benefits at partial retirement, so doesn't need to have alpha. So for NUVOS membership, if he chose it from the 1st of April 2008 up until the 31st of March 2015, that he would be able to take a pension of £5,503.71 with no automatic lump sum. If he chose for the remedy period to be covered by the NUVOS scheme, so from the 1st of April 2008 when he joined, up until the end of the remedy window, so the 31st of March 22, he would be able to have a pension of £10,287.68 with no automatic lump sum. He would then be building pension benefits up in Alpha from the 1st of April 22. So when applying for retirement, so we have our standard timescales where we say approximately 4 months before your intended last day of service, have that conversation with your employer. Your employer may need you to have that conversation earlier than that so that they can look into facilitating your change in hours or downgrading. So Joe showed you the forms that needed to be filled in earlier on. So your employer will then need to notify us of your last day of service. And provided that we have everything we need for the team that are providing those calculations, so they're checking your data, querying any of it with your employer. So when we've got everything that we need, we will then create that retirement quote. So before sending the quote, as I say, it needs to be up to date because, and everything that we've had from your employer, because that impacts the output of that calculation. So approximately 2 months before your retirement date, the quote will be sent out in the post. We ask you to return the forms and your quotation to Civil Service Pensions, and we ask for that normally a month before your retirement date. That just gives us enough time to get everything processed and get everything paid on time. We will check the paperwork and we'll have a look at that in a moment to make sure that we've got everything we need in order to put that into payment. You'll then get a statement confirming how much your final pension is that's being paid to you and the lump sum if that's the option that you chose, and what the payment dates will be. So we would aim to pay your lump sum if that's what you chose a couple of days after retirement, and then your pension will be paid a month in arrears and will be paid at the same time every month for the rest of your life. Now, looking at the retirement quote, so this is what they're looking like for the remedy options. So they differ from if you've had a quotation beforehand. So it explains what's included in your quote. It will then reference the 2015 remedy choice. So option A is start date from when you joined your original scheme up until the 31st of March 22. So you're essentially picking your original scheme, your legacy scheme for the remedy, and then Alpha from the 1st of April 22 to your last day of service. And then option B is when you started your original scheme up until the 31st of March 2015, and then Alpha from the 1st of April 2015 to your last day of service. So you're choosing your remedy scheme to be Alpha. The pack has a lot of information and useful links, so please do take the time to read through it. You'll then see your personal details and the scheme that it's referencing. It will give you the earnings figure that's been used in the calculation and provide you with information on how that's been calculated. It will have your reckonable service, and that's calculated in years and days for your final salary scheme. So just bear in mind that from Alpha, it doesn't include service in the calculation, so that will no longer be building up from when you moved into Alpha, unless of course you were purchasing additional service. You'll then be given your pension figures, and those will be annual figures and before any deductions have been made, because we won't know what the tax is, if there's any to be paid, until it's in payment. You'll then have information relating to your lump sum options, and it will give you details about how you can exchange some of your pension for a tax-free lump sum. And it will also reference the lifetime allowance. So you may be familiar with this. It was talked about in the budget of this year and how some changes have been made to it. We do still need to look at it when it comes to lump sums, for example, so you will still see information relating to that. Please do look through all the information that's provided for this and to ensure that you're filling in the right details on the form. You have your personal details form. So as it says here, it's pre-populated with your information. All your information comes across from your employer. So if you do identify that any of that needs to be changed, then write those changes on the form and add your initial and the date to that form so we can see it was yourself that was made. Also look at your death benefit nomination form. This is then asking for payment information, so bank details and accounts for where it's to be paid to, addresses, So please make sure that that's filled in. As it says on there, if it's not filled in, then payment could be delayed if we don't have the right information on there. And on here, it's asking about marital status. So if you're divorced, for example, then it tells you what certificates information that we would need to see. So please do review this and make sure that you're returning what's expected. It's asking for current spouse and civil partners information, so please review that. And then here's where it starts to ask you information about your lifetime allowance. So this is one of the areas that we find that some people can maybe get a bit bogged down with the wording, completely understandable, but please do take your time to read through it and make sure that it is filled in, because again, if it's not filled in correctly, then we may need to return it to you. Sign and date your declaration and then complete your lump sum option forms. So there's a lot to fill in there, and certainly what I do when I've got lots of paperwork that needs to be filled in, I'll ask somebody else to almost sanity check it to make sure that I've not missed anything out. And also you could ask somebody to go through it, just make sure that if you've got any questions, you might just need a sounding board on it. That would then be returned to us, and if everything's completed, we can then go into the process of putting your pension into payment. But that's it for me with regards to the presentation, and I'll pass back to Catherine.
Thank you, Michelle. That was great. Really good to see that step-by-step guide to all of the paperwork. It certainly can be a confusing time. You're very keen to make those decisions and get your retirement going, but of course, it's just really important to make sure that paperwork's completed nice and accurately. We're going to move on now for the latter half of the session and start answering some of the questions that you've submitted. Questions are coming in thick and fast. Thank you so much. We're trying to focus on answering the most upvoted questions, those most relevant to today's session, and those that hopefully haven't already been covered during the content so far. So let me just have a little look at what is currently the most upvoted question. So from a member who said, I have both a classic and alpha pension. I may fully retire at 60 and take my classic, but not claim my alpha pension. I would wait to take my alpha pension at the state pension age. My question is, will my alpha pension be more if I claim it at age 67 as opposed to age 60, even if I'm not working and contributing to it during those years? So Joe, if you could pick that question up for us, please.
Yep, certainly. So there's a couple of things to consider here. Part of that is really what you mean by more in these circumstances as well. So claiming both pensions at 60, as you touched on, would result in your classic pension being paid in full, but your alpha pension being reduced if you claimed it at that point. Now, if you don't claim your alpha pension at that point, you can then claim it at any point further down the line that you wish to. And the reduction is basically greater the earlier you claim it. So if you don't claim that pension for a couple of years, the reduction will be less. The nearer you get to that age of 67 or whatever your alpha pension age is, the less reduction will be applied. So you will get more alpha pension if you claim it at 67 than you would have done if you claimed at 60, because it won't have had that reduction applied to it. You will, of course, have been getting inflation on top of that pension each year as well to keep it up to date. So really some of that comes down to what your needs are, what you can afford to live on at that point, and how big a difference that reduction will make to you, depending on what you want in the meantime. So I hope that's answered that question for you. And I will hang back to Catherine. Thank you very much.
Thank you, Joe. So yeah, absolutely. If you claim the pension later, then the annual amount will be higher. But of course, it's going to be paid to you for less years. So like Joe said, it's which is more important to you, having the higher rate further down the line or having it payable to you that lesser rate for longer. Another important factor just to mention there as well, that if you were to leave that alpha pension from the age of 60 to 67, it does still get an inflation adjustment applied to it every April as well. So it will still grow from 60 to 67, as well as not having that reduction applied to it. Our next most upvoted question comes from Ian, and Michelle, I'll come to you with this one. So is there a scenario where it may be more beneficial to opt for alpha over classic for the period of the remedy? Michelle, if you could give us your thoughts on that, please.
Yeah, absolutely. And Ian, I think there's an awful lot of people that would be thinking the same based on the fact that it's one of the most uprated questions. So the accrual in Alpha can actually build up for some people an awful lot quicker. So the build up of pension is quicker, but it will be individual to each person, and that's why you're going to be given the remedy options. It goes up each year based on your salary and an accrual rate of 2.32%, but it also gets a cost of living adjustment applied to it as well. So if you bear in mind, then that could be 7-8 years of Alpha building up based on your salary with the cost of living adjustment applied. And the latest one to be applied at April is 10.1%. So for some people, that remedy period in full, including the fact that you're in Alpha now, it could mean that those figures are higher. So that's one of the reasons why that move over to Alpha for some people not going and some tapering and some moving straight away was challenged, because it can be a better pension build up in there, and that's why you'll be given the options. You will start to see the information side by side on your statements next year, for example, and on the remedy calculator online, so you will see that build up.
Thank you, Michelle. That's great. It's a really good question. I think there's a lot of assumption out there that some of our legacy schemes might be more beneficial than Alpha in all cases, but it really is individual to everyone's personal circumstances, and lots of factors like how your salary's changed, the rates of inflation, like Michelle said, and also the age at which you decide to retire. All of those factors will make a difference to which of the choices is the best one for you. So best thing really is to reserve judgment until you do see those figures. It might be what you've got on your current annual benefit statement is the best that it will be, or it might be that those figures increase in the future. Certainly shouldn't go any lower though than what you're seeing at the moment. So that's probably the best way to look at it. It might get higher, but it certainly shouldn't get any lower than what you're looking at the moment. Okay, so our next most upvoted question comes from Mark. Is there a particularly good time of year to retire given tax purposes and the pension is much lower and may take you below a tax threshold? Joe, thoughts on that one, please?
Hi, yeah, thanks, Catherine. I think this is one of these where the question's partly been answered in itself, and I'll also say before I get into anything too detailed that we aren't tax experts. So in terms of specific tax guidance, I'd always recommend speaking to HMRC specifically about those subjects. Now, as you kind of touched on in your question, there are two forms of income you might have. There, a salary and your pension. They're both taxed as income tax, and your income tax is assessed throughout the year on the basis of what you're earning. Now, in terms of there being a particularly advantageous time of the year, that is partly wandering into taxman territory, but I'd also say that is going to depend on your exact circumstances, depending what sources of income you have, what you're claiming at what point, and where you sit with those thresholds. The answer is going to be slightly different for each person, depending on how much they're earning, at what point they may be crossing different thresholds, especially if those earnings are varying through the year, how much pension you're claiming, and any other pensions that you might be claiming at the same time as well, of course, because that will affect your overall income level. So I would say there's not any particular trick to this. There's not sort of a secret special bonus answer to this question. It will depend on your circumstances, what you're drawing and when, and for more specific information, you may want to speak to the taxman. And I think that answers your question, and I'll pass back to Catherine.
Thanks, Joe. That's great. Our next question, I'll come to you, Michelle. I recall that the employee contribution rate was lower in Classic than it is in Alpha. For those affected by the remedy, if they choose Classic for the 7-year remedy period, will the difference in their contributions be refunded to them too? Michelle, thoughts on this one, please?
Great, thank you very much, and I'm sure a lot of people have thought the same thing. So Classic initially was a non-contributory scheme. So what that means is there was no contributions needed to go towards it. So your contributions are used to make sure there's money there to pay out your pension. But gradually over time, the contribution rates became the same for all of the schemes. So around 2012, 2014, they started to become around the same percentage. So they were the same then from 2015. So if you remember, this was before the McCloud judgment was looked at and some people were remaining in Classic. So contribution rates were the same regardless of what scheme you are in. So there won't be anything to pay back because they would have been the same even if you've remained in Classic for that period of time. I hope that's answered your question. I'll pass back to Catherine.
Thanks, Michelle. Francesca's submitted the next question. I'll come to you with this one, Joe. So how does it work for those who retire but don't draw their pension? Does their pension pot continue to grow? If so, how does a pension pot grow in the absence of payments in? And is there a calculator to have a view of how this works? So Joe, if you could give us an idea of how that situation would work, please.
Yeah, thank you very much. So there is a potentially few scenarios here. So I'll touch on a couple of different ones just to pick up on anybody else that might be thinking about a similar scenario. So if you've retired, so you've left altogether, then at that point your pension does not grow any further. You'll get inflation added on each year, but that essentially is to keep it up to date. It's not growing in value as such. The point that you're not employed anymore, no further pension amount will go into those pensions. So if you, let's say you left the civil service at 55, you've got a classic pension and you choose not to claim that until 60. What will happen basically is at the point that you come to claim that pension, we will add on all the inflation that was due back from when you left at 55, and we'll pay out that uprated pension at that point. So it won't have grown, but we will have kept it up to date with inflation. Now, if you're in a situation where you've partially retired, as Michelle touched on earlier, essentially the pension you claim at that point goes into payment, and that's then fixed other than getting inflation on top of it. Any pension you don't claim and your alpha pension will continue to grow whilst you remember. So you'll continue to build up alpha pension even while partially retired up until the point that you do come to claim it. I hope that's answered that question for you. Thank you very much, and I'll pass back to Catherine again.
Thank you, Joe. Yeah, so if you don't claim your pension benefits, we wouldn't necessarily treat that as a retirement. We would treat that as a resignation from the service, and your pension benefits would be held preserved, but adjusted annually with inflation. And we'd expect you to come back and claim them at your normal pension age of 60, 65, state pension age, whatever it is, depending on your scheme. Although you still have the option to claim your benefits early on a reduced basis if you would like to. There's a couple of questions I'm just going to pick up quickly about the retirement modeler here. So someone's asked, when will the retirement modeler be updated to include the McCloud judgment, the 2015 remedy? So that is being worked on at the moment. And certainly by the time we get annual benefit statements in 2024, with the remedy figures included, the modeler will definitely be ready before then for you to be able to use that in conjunction with your annual benefit statement. We do already have the retirement benefit illustrator available on the scheme website, and that just gives you your figures just for that 7-year remedy period. It can give you an indication. It's not 100% accurate, but it's there as a short-term measure until that modeler is ready for you. So the retirement benefits illustrator is available on the 2015 remedy pages of the website if you'd like to have a look in the interim until that modeler is ready. Someone's also asked, does the modeler work for partial retirement quotes? If so, how do you access that section? And yes, in short, yes. So the figures, whether you're fully retiring or partially retiring for your pension benefits, will be exactly the same. So the figures provided by the modeler will work in the instance of both full retirement and partial retirement. And then there was one more I was just going to pick up. So will the McCloud judgment risk a worse pension than anticipated by the retirement modeler? So it could be giving you that alternative choice, whether that's putting you back in your previous scheme for those 7 years or putting you in alpha for those 7 years, depending how old you were and what the impact was when the remedy came in and alpha came in 2015. It could be that the alternative choice gives you a lower figure than what you see on the modeler at the moment. But obviously, if it does give you a lower figure, then you're likely not going to choose that one and you'll choose the higher figure that's already there. But those figures will be provided in the process when you're retiring and will be made nice and clear so you know which of those decisions is the best one for you. OK, so we've got a question then from Rob. So I will come to you, Joe. If I partially retire at 60, can I just draw the classic and freeze my alpha and draw that later? If you can pick that one up quickly for us, please.
Hi, yeah, certainly. So yes, in terms of that question, if you partially retire at 60, you can just draw the classic and the alpha will continue to build up then until you fully leave. Basically then at whatever point you want to, you can claim your alpha at the point you fully retire. You can also do another partial retirement using the alpha pension further down the line as well if you wish to. So you could take another 20% drop further down the line and claim that at that point as well. Equally, you could draw a bit of both at your initial partial retirement as well. I hope that answers your question, and I'll pass back to Catherine again.
Thank you. And there's just a follow-up question there from someone saying if they leave work or service but don't take their pension immediately, how do you access the pension later when you're no longer employed? You'd simply get in touch with the scheme and let them know that you'd like to put your pension benefits into payment. Again, we are asking for 4 months notice to ensure there's sufficient time to do that and protect your retirement date. So all of the contact details that you need for the scheme available on the scheme website. But yeah, you just get in touch to do that. Michelle, question for you now. So someone has asked, how do pending pay awards impact on your pension? So for pay awards pending at point of retirement, if you could give us a little explanation of that, please.
Yeah, absolutely. So when we provide your quotation, it's all based on the information that we have at that time. So if we then get information after you've retired or in the process of when we provided the quotation up to you retiring, that information will come through from your employer, and we will then recalculate your benefits and be in contact with you about how that's affected those. So it's not a cut-off. If we don't have the information, we don't include it, but we will absolutely, when we get that through from your employer, recalculate your benefits and then be in contact with you.
Thanks, Michelle. I'll pick up the next question myself. So someone's asked, can your employer refuse partial retirement, and what would my options be if this is the case? So as we've discussed, in order to take partial retirement, you need to agree with your employer to reduce your pensionable earnings by at least 20%, which most people will do by reducing the number of hours per week that they work. But of course, it could be done in a different way by downgrading, starting to work part year, something like that. It'll depend on what's available based on your individual position. Like any request for part-time working, of course, it needs to fit in with your employer's objectives, and they need to be able to accommodate that change. So if you are trying to apply for partial retirement, then you might need to consider alternative options. If you could move, for example, to another area of your business, or even another civil service department, if that's not something that's an option where you're working at the moment. But your employer, of course, doesn't have to say yes to any request, but certainly, hopefully, they'll look at any requests for partial retirement favourably, but it's ultimately their decision to make. So hopefully that answers that question. Sorry, just checking out the next couple of questions. So Joe, if I leave work at 58 but don't claim my pension until 60, is it correct that my pension will not be reduced by the early claim reductions?
Yep, if you leave at 58, we'll calculate your pension up to the date that you leave. And then if you don't claim it until 60, that will get paid out in full when you hit 60 and claim it. And we'll also add on any inflation that will be due between 58 and 60 as well, to take account of that pay difference. So yeah, it will get paid out in full with inflation at that point. I hope that answers your question. And again, back to Catherine.
Thank you. We have a question from Andy next, who said, does taking your classic or alpha pension midway through a financial year affect the cost of living increase to the pension in the following financial year? Michelle, if I can hand that one to you, please.
Yeah, absolutely. So it's the increase that's applied is based on how long you've been receiving your pension. So if you've been retired for 6 months by the time the increase is applied, then you would get a proportionate increase. And then the following year, as you've been in receipt of it for a full year, then you'll get the full year. So it does impact what's applied, and we will apply it based on the proportion of how long you've been retired when that time comes around.
Thanks, Michelle. Yeah, that makes sense to me. You'll get a proportional increase in your first year of retiring, but otherwise you'll get the full increases every year thereafter. Our next question, it's quite lengthy. I'm just going to shorten it a little bit, and it's essentially about the state pension and being contracted out, which the civil service pension scheme was until 2016 when the government abolished contracting out. Joe, could you give us a few words on the impact of contracting out on civil service and state pensions, please?
I think in some ways you've answered the question as part of the question, but you're essentially correct in that at that point where contracting out applies, the two pensions may balance each other out or equalise. And effectively what that means is there's a slight rebalance between the two to make sure that the correct overall level of benefits is being paid out in terms of the legislation, etc., that was in place at that time. One of the key things with that is, though, that rebalancing is rarely a very high amount, so that you'll see a slight adjustment to the figures. You won't see an overall reduction. It will be an equalisation between the two. And although it technically does happen, it's not, generally speaking, a big shift in the benefits that you'll receive. hope that puts your mind at rest slightly. I'll pass back to Catherine.
Thanks, Joe. That's great. So we've got a question from Anonymous. I'm already 61 and have been in the scheme since the 1980s. Why can't I find out my choices under McCloud before I choose to retire? So I'll just pick that one up quickly myself. So as we've discussed, from next year, your annual benefit statement will give you both sets of figures for that remedy period. So we're not in a position to provide those figures to everybody as of yet. The last little bit of legislation to be able to implement the 2015 remedy is just in progress at the moment. So that has to be passed through Parliament and made the actual legislation before everything can be input. So that's taking place effective from the 1st of October. And that means that with everyone who's retiring from the 1st of October, they're getting those figures at that time. For everyone else who's not close to retirement, from next year, you'll get those figures on your annual benefit statement. So you'll be able to see every year what difference that 2015 remedy or McCloud judgment is making. So it's a work in progress. We're almost at the end of that, but the legislation not being in place has allowed us to not give everyone those official figures just as of yet. So next question for Michelle. So can you please explain how I can add to my pension? Session I attended a couple of days ago stated by paying £361 per month, it would add £4,000 to my pension. Is this correct? Obviously, that was a very specific scenario, but Michelle, if you could just give us the basics of added pension and how it works, please.
Yeah, absolutely. So with regards to added pension, the whole process behind that is you paying additional contributions that will directly impact your pension. Now, the figures that were quoted were in relation to specific information added to that pension calculator. So if you go onto the Civil Service Pension Scheme website, look for added pension, there is a calculator, and that would allow you to say, if I was to pay so much, how much extra pension would I get? So it's based on your specific information and absolutely worth having a look. What was quoted on another session was based on certain information added in. So it's different for each person and the info that's added on there. So do go and have a look and see what it would quote for you based on the information you add in.
Thanks, Michelle. Yeah, added pension, just a note that the deadline for applications is normally early in March. Your added pension contributions, if you want to pay from your salary, have to start on the 1st of April. So good idea to have a think about it nice and early if that is something that you'd like to contribute to build a bigger pension for the future. Our most upvoted question, I'll just pick up very quickly before I give Joe another question. So how accurate is the retirement modeller? So the key thing with the retirement modeller is that it's based on the information from your annual benefit statement. So it's a good idea to understand whether the information contained within your annual benefit statement is correct. Obviously, lots of efforts are gone to ensure that information is as accurate as possible. But it's really important that you do check your annual benefit statement every year to make sure that it looks like all of the figures contained within it do correctly reflect your circumstances. Our session on Tuesday, Life Events 1, if you didn't attend that, had a really good step-by-step guide to the annual benefit statement. So might be an idea to watch that back if you'd like to sort of get a better understanding of your annual benefit statement and how you can check the figures within it are definitely correct. It's then the retirement modelers then doing projections for the future. Obviously, we can't predict how your salary is going to change in the future or predict what future rates of inflation will be. So it's done on a moderate basis there. That would obviously have to be taken into account. We can't predict what the future looks like. But if retirement's fairly close and obviously those salary and inflation figures aren't going to change a great deal, then it should be giving you a really accurate figure as long as your annual benefit statement is correct. So I'll come to Joe with probably one last question before we wrap things up. So if the widows and orphans contributions is repayable under the classic scheme at retirement, is that paid by way of a lump sum? And if so, is that lump sum taxable? Joe, could you give us some more information about that WPS refund, please?
Yeah, so for classic members have always paid a rate of 1.5% towards just family benefits or the widows and pensions scheme. So if you're paying 6% as a total, for example, 1.5% of that would have been purely towards widows and benefits, widows and children's even. Now, classic members, because they've always paid for this family benefit, if they are single when they leave, they may be entitled to a refund of some or all of those contributions, and that will be back to the day that they became single. So it could be all the way through your career if you've been single all the way through. If you got divorced, for example, it will be back to the date of divorce. Now, at the point of claiming your pension, that will be paid out as a lump sum at that point. We'll pay that out automatically once we've received your application. We can't usually quote it ahead of time, partly because we often don't have the figures until we actually go through that process. It will be paid automatically as part of your lump sum entitlement, and it's always tax-free. Hope that helps, and again, I'll pass back to Catherine.
Thank you, Joe. That's great. That's all of the questions that we've got time for today, unfortunately. Thank you so much. I think we've had the most questions on this session than any that we've run so far in Pension Awareness Months. Lots of questions. Hopefully we have answered quite a lot of them for you already today. As I mentioned earlier, if you have had a question that hasn't been answered, then you can think about attending one of our Pension Power sessions, which are run every single weekday. It's 1 hour, gives you a broad overview of the Civil Service Pension Scheme, and they run to small groups of around 30 to 40 people. So there's a lot more opportunity to ask and have your questions answered at those sessions. We will be sending out a feedback survey following today's event. Please tell us what you think. Tell us what we did well and what we didn't do so well. We do use that feedback to shape any future sessions and information on the website and all those kind of things as well. So that's everything for us from now. If you're joining us on one of the other sessions later in the month, we will see you then. But have a great rest of the day, everyone, and bye for now.